Hello traders, welcome back to the Forex Geek channel where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the 8-hour chart strategy, a method that can transform your trading approach. The 8-hour time frame sits in a sweet spot between the daily and the 4-hour charts, offering you a cleaner market signal while filtering out unnecessary noises. Stay with me until the end of this video while I break down on real chart examples showing you exactly how to spot these sweet setups, where you can place your entry, and most importantly, how to manage your risk. Now, looking at the market overview, we can see that the 8-hour time frame presents a unique perspective of the forex market that many traders miss. When you open the chart, you would see and you will notice that you would have three distinct trading blocks throughout the day, giving you a clearer view of the market structure without confusion of shorter time frames. Think of the 8-hour as your market filter. It removes the day-to-day noise in the market and often traps that traders face, like false moves, while trying to capture essential price movement that matters. Each candle represents a completely different trading section. One candle represents the Asian section, the other candle represents the European section, and the last candle represents the American section, allowing you to see how institutional money flows through the market. Now, let's look at this candle, one of the 8-hour candle. We can see that this 8-hour candle on the 1-hour time frame, it captures the activity that happened in this area. This one candle has already filtered this noise that went on in the 1-hour time frame. Notice how clear price action becomes compared to the busy movement on the lower time frame. This clarity helps you identify genuine trading opportunities rather than market noise. The beauty of this time frame lies in its efficiency. You will spend less time analyzing your charts while focusing on high probability setup. This means you can maintain your regular work schedule or daily activity without being glued to your screen. Let's look at three 8-hour candle and see the magic that happens in the lower time frame. This is what happens within 3 hours of your time. 3-hour time frame. This is what happened in 3 8-hour candle in your 1-hour candle area. If we change it to 15, we will see more noise. Let's change it to the 15-hour time frame, the 15 minutes, and see the noise. You can see this shows more noise going on in the market, though the market is trending and is looking clear. But imagine checking this on a rangy or sideways moving market. You see there will be a lot of noise in such area. So let's see how we can technically set up for this strategy. Let's break down the extract process of implementing this strategy on the chart. We start by identifying the primary trend using higher highs and higher lows for the uptrend, while lower highs and lower lows for the downtrend. Your first task is to mark out your swing points clearly on your 8-hour time frame. This is basically marking out here as your higher high higher low, higher high, higher low, potentially a higher high. When you can spot a clear trend, you have to look for two specific conditions. First, ensure price remain within 20 moving average for the uptrend. We have to make sure that price is above. This shows that yes, we are in an uptrend. Shows that price is trending to the up direction as long as price is above the 20 moving average. And when price is below the 20 moving average, it shows that we are in a downtrend. Secondly, we have to confirm each swing maintains its pattern without breaking the previous structure. For trade entries, we have to wait for price to pull back to the moving average. When price pull back to the moving average, this creates your opportunity zone. Your stop loss should sit below the most recent swing low for an uptrend, while it should sit above for your most recent swing high for a downtrend. Let's examine specific trading rules while taking such trades. But before that, if we are to enter a trade, we are meant to put our stop loss below the swing low. That's in case of a bullish market. Why, if we are talking about a bearish market, let's assume we are trying to take this bearish trade, the stop loss should be above the swing high. Now, let us look at the rules that we need to consider while taking this trade. First of all, we have to wait for 3 consecutive higher highs, higher lows rather. We have to also wait for price to stay above the 20 moving average. That's if it is in a long trading position. If you are trying to look for opportunities in a long trading position, you have to make sure price stays above the 20 moving average. Then we have to enter when price touches or bounce from the moving average. We also have to set our stop loss below the last swing low. We can put it 20 pips below the last swing low, or 20 pips above the last swing high. Now, in case of a short position, when we are talking about short position, we can decide to look for 3 consecutive lower highs. That's lower low, lower high, lower low, lower high, lower low, lower high. These are the 3 consecutive lower highs. The second step is we should make sure that price sustains or remains below the 20 moving average. As you can see, price is trading below the 20 moving average. Then we should enter our trade once we see price has touched or rebound on the 20 moving average. So in terms of a bearish trade, once we notice price has bounced on the third or has bounced on the moving average, we can enter there. Enter here, you put your stop loss above the previous swing, the lower high, the previous lower high. That's how we trade the trade. We take this trade. Your target should be at least twice your stop loss. This maintains a healthy risk to reward ratio of 1:2. Is always better. You can also target 1:3. You can also close half of your position at the first target. You can target, your first target can be a 1:1. You can close half of your position, or your first target can be a 1:2. You close half of your position and let the rest run. Now let's look at how we can apply this strategy in an advanced technical way. Now that you understand the core strategy, let's enhance our trading with the advanced technique that will sharpen our entries and our exits. go back to our 8-hour time frame. First, incorporate the support and resistance level on your 8-hour chart. We'll have to let me use this example, this chart for example. When we incorporate our support and resistance area on the 8-hour chart, things become a little bit easier for us. So I would quickly draw our support line here. This can be a support because I can see multiple rejection in this area, this area. This can be our resistance line because there are multiple rejections too. After we draw these levels from the previous month's price action, we focus only on the area where price reacts multiple times. This zone work exceptionally well with our strategy when they align with the moving average. So let's focus on an area that my price has reacted or touched multiple times. We add our Fibonacci retracement tool to analyze where price will draw it from the most, where price will react from, by drawing it from the most recent swing low to the most recent swing high in an uptrend, and from high to low in a downtrend. We focus particularly on our levels from the 50% level to the 61% level in case of any retracement. So this is how we would react in such condition. We will draw our Fibonacci from the most recent swing low to the most recent swing high. We react when price gets to from 50% or from the 61% level. These are the levels, if you can see them. Remember, when price comes in contact with your 20 moving average on the 8-hour time frame. When these elements converge, we have found out that what we call a high probability setup presents itself. This setup typically offers the cleanest move with minimal drawdown. The key is not just to overcomplicate your analysis. These two should complement your core strategy, not override your strategy. So, alright traders, I believe we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do well to not forget to like, subscribe and share. Turn on your notification bell so that you will never miss out on more trading tips and strategy. Thank you for watching, and I will see you in the next video.